Hello, welcome back. So in today's video, I'll be talking about the stocks that just crashed and what I'll be doing with them. So for reference, this is my portfolio. So I'll be talking about some companies in this entire list here. I'll be talking about Visa, Amazon, as well as another company, which is FICO. So let's talk about Amazon stock first. So Amazon is down around 8%. It was down 8% on Friday. It is currently trading at around a 32 times earnings. So for Amazon, their earnings were quite decent on the surface. So if you look at the net income, it actually increased by around 59%. Earnings per share beat estimates, revenue beat estimates as well. And then they also guided up in terms of their net sales for the next quarter. So AWS came in at 30.87 billion as compared to the 30.8 billion expected. And the advertising also beat estimates. But despite all these different metrics, the stock actually dropped. So for Amazon, if you have to look at their cash flow statement, the cash flow statement is actually a bit skewed because they bought in a lot of inventories. So over here, as you can see, the inventories, the cash flow based on the inventories is actually negative this quarter. What this means is that Amazon actually bought in a lot of extra inventory to try and bypass all the different tariffs. And that's why you're seeing that operating income only increasing by around 12%. So if you have to normalize that portion, it actually grew at around 15 to 17%. So besides that, this is Amazon's income statement. So their total sales increased by around 11%. It is quite healthy considering it is one of the largest companies in terms of your revenue. Their operating expenses grew at only 9%. So when you have a company that is able to grow its revenue at rates that are faster than its actual expenses, what this is it is operating leverage, meaning to say that the company is becoming more efficient, the company is increasing expenses at a lower rate, which means the net income will grow a lot faster as compared to the revenue. So that's why we saw operating income coming in at 25% year on year, which is extremely healthy for a business like Amazon. Besides that, this is their balance sheet. So the cash actually dropped by around $20 billion and their property, plant and equipment actually went up by around $40 billion. So what this means is Amazon is spending a lot of their cash on capex, but it is healthy for now. They still have a healthy cash balance. And their long-term debt is actually decreasing also. So the company is not taking on more debt to basically come into capex, which is healthy overall. Unlike Meta, which is trying to raise debt and raise equity to try and pump in more money into AI and capex. So this is why exactly the stock dropped. So the stock dropped because they said AWS is too big. AWS is growing slower than its competitors like Azure as well as GCP because it has a larger base. So AWS only increased by around 17%. Azure went up by 39%, whereas GCP went up by 32%. AWS is losing share to GCP as well as Azure. So while it is negative that the revenue only increased by around 17%, their backlog actually accelerated to 25%, which is quite positive for the business. Besides that, the Big Beautiful Bill also came out. So this is a positive for a company like Amazon, especially because the company is quite dependent on consumers. So the Big Beautiful Bill will basically spur consumerism in the US and consumption as well, because the bill will offer tax reliefs for all the different US citizens out there, which will increase consumption as well. So for Amazon, it is a company that will stand to benefit from this bill the next few years. So we'll have to see how that portion plays out. So for Amazon, this is my valuation for the company. So assuming a 28 times earnings on the left and a 15% growth, at $215 a share, the company will give you around an 11% return. So I think the company right now is around fair value. At $200 a share, the return profile is a lot more positive. So you'll be getting around a 13% CAGR from this company if it can grow at 15% over the next 5 years. So at $200 a share, I think it is a much healthier entry as compared to its current price. So I don't think I'll be adding for now. And for Amazon, there's another bear thesis as well. So Amazon's capex this year and the trailing 12 months is around $100 billion. They're preparing to increase it to around $118 billion. So a lot of the capex is actually pumped into AI data centers to spur Azure's growth. And if you have to look at Azure's growth in terms of revenue in the trailing 12 months, it's actually around $20 billion. So if the capex is depreciated over, let's say, a 10-year period, so let's say they spend $100 billion and then each year it depreciates by 10 billion. So if you were to add on all the past capex and subtract the maintenance capex of the company will be spending around $15 billion every single year, basically to increase the growth of the company. And what they're achieving is actually around $20 billion worth of growth. So unless the company can maintain this $20 billion of growth in AWS for the next 5, 6, 7, 8 years without increasing the capex, then I think the capex right now is not worth it. So this is actually one bear thesis that I've been looking at. The company's capex could be getting out of hand. The company can't produce returns on its capex. Then all this capex will lead to earnings depression over the next few years, especially with the depreciation increasing over time. So for Amazon, it is a quality business that will be around for a very long time. It reported decent earnings as well and it fell. The company is about fair value right now. I'm not planning to sell it, neither am I planning to add any to my position. I'm waiting out to see if I can buy more if it drops to a decent price. But of course, the capex concern could be one to look out for as well. The company is spending a lot of money into capex to produce not very substantial amounts of return. And if you think this is the end of the cycle, then this could be a bad time for you to buy into Amazon. The next stock that I'll be covering today is FICO. So FICO on Friday was down around 4%. It is currently trading at around 54 times earnings. So for FICO, this is their main business model. Basically, they sell your credit scores. They license out your credit scores. And if you're to look at the credit scores over the past 7 years, there's basically 10x in terms of pricing. So it went from around 60 cents to currently at around $5. So that's around an 8 to 9x in a span of 7 years. And for this company, what it has done over the past few years is it has basically increased its prices so drastically that now regulations are coming in and looking at this space. So for FICO, the moat is basically just your regulation, your intellectual property associated with the FICO score, as well as network effects. I think out of these three, the strongest one is your network effects. So previously, your regulations actually only allowed FICO Classic for your government-sponsored enterprises mortgages, but currently now, Vantage Score will be allowed as well. So this could reduce FICO's market share, which could be bearish for the stock, and this is what the market is starting to price in. So for FICO, this is the problem with the business. They have hiked their prices too fast and too much, and they will have to slow it down, which will be a headwind for the growth, because they don't want to attract even more scrutiny into the business. The company is high quality, but the market share concerns can suppress the multiple. I'll be looking into this one further. It might be interesting soon with the volatility. But for now, I think the risk is still there for a company like FICO. There are too many ifs, and there's a lot of downside risk, especially with the public scrutiny right now. So the three main downsides will be increased regulation by Bill Putte, increased competition with Vantage Score, as well as reduced pricing power. So if Bill Putte comes in and offers even more alternatives to your FICO score as well as your Vantage Score, then you will see reduced pricing power from FICO. And besides that, if Vantage Score gains more credibility, if Vantage Score steals more share, then there will be reduced pricing power on FICO's side. So with all this, I think 50 times earnings still looks a bit steep for the company. Although the company is projected to grow at around 20 to 25% over the next few years, I think at this price today, there is a lot of valuation risk unless you can assume that the company can continually increase the prices over the next few years. So this is FICO's valuation. So assuming a 35p for the company and assuming a 15% EPS growth, this company will give you around a 5% return over the next 5 years, which means that the company is currently overvalued. So if you're to assume a more bullish estimate of around a 40 times earnings, and assuming a 15% EPS growth, this company will give you around an 8% return over the next 5 years. So at its current price, although I think FICO is probably around fair value today, I think the company has a lot of risk. It has regulation scrutiny, it has public scrutiny, and I don't really agree with the company's capital allocation. So the company has been raising a lot of debt to buy back shares. I disagree with that, especially when the shares were so expensive, back when it was $1,900, $2,000, and the leverage on the company is getting a bit too high. So for a company like FICO, I think at today's price, you're getting the stock at around fair value if it can grow at around 15%. The next stock that I'll be covering today as well is Visa as well as MasterCard. So Visa was down another 2% on Friday. It is currently trading at around 33 times earnings. So for Visa, this is their moat in question. So what could go wrong with Visa? First one is basically your crypto. If you see more crypto payments that could steal share from Visa's traditional payment network, there is increasing amounts of local authorities creating their own network. So for example, in Singapore, you have PayLah, PayNow, and in other countries as well, you have other alternatives. This could disrupt Visa's payment network. And another possible risk is a US economic depression as well. But out of all these three, there's a counter argument that can be made. First one, crypto. For crypto, MasterCard as well as Visa, they're already coming out with their own plans to venture into that space. And with their current existing base and infrastructure, they will probably be one of the biggest beneficiaries if crypto comes into the space because they already have the infrastructure that's being built up. Second one, local authorities creating their own networks. For Visa, the most lucrative portion of the business is actually international transfer. So when you transfer your money from one country to another country, that is where they make their most money. And for all these different local authorities creating their own network, while Visa would lose share in that portions, those countries, they have to internationally trade. And when they trade internationally, what happens is Visa will still be able to make money. As for US economic depression, I mean, most companies, they suffer from this when an economic recession actually comes. So this is macro driven. It is nothing structurally wrong with the company. So while I think this should be included in your thesis, I don't think it is a very strong argument against why Visa is a poor company. So for Visa, this is what could go right for the business. So number one, it is inflation hedged. So when you have inflation, rapid inflation, Visa will basically grow with rapid inflation. You have consumer strength as well in the US currently. Your retail sales number have actually come in relatively strong. Your big beautiful bill is spurring growth as well. And you have a stable, predictable business that will just keep growing and growing and growing. So for Visa, it is one of the best companies out there to own. While it doesn't give you the best returns, it is a predictable company that you can comfortably hold in any sort of economic environment. So for Visa, this is my valuation for the company. So assuming a 12% free cash flow growth over the first 5 years and assuming a 10% free cash flow growth over the next 5 years, at its current valuation today, I would say Visa is around fair value, around $335 a share. So for Visa, I view this as a high quality business, as around fair value today. I'll be looking to add it soon if it drops to an appropriate price. Let's see if it gets there soon. Last portion, I'll be covering some questions left in the comments. So the first one, it says, "Hi Guan, I've been really enjoying your videos. I'm a new subscriber and I find your videos very helpful. I was wondering your opinion on my portfolio." So thank you for submitting this one in. The portfolio is as follows. So you have Microsoft at 20%, Google at 18%, ASML at 18%, Amazon at 10%, MSCI at around 9%, Nvidia at 9%, Equifax at 8%, Visa at around 3.85%. So I agree with the Microsoft pick. Microsoft should comfortably be one of the largest weightings in your entire portfolio. It is bulletproof. It is the company with the least downside risk in terms of the earnings of the company. So I think the 20% is fine. But of course, if you think the company is overvalued today, you might want to allocate capital elsewhere. Google is fine as well. It is another company that is undervalued. As for ASML, I think an 18% holding may be a bit too high. It is a company that still has risk. So you currently have around 20% of the revenues coming from China. So when you're thinking about the weightage of your stock, maybe you can try thinking about it this way. Try and use an inversion mental model and think of the risk of the company. And for ASML, the biggest risk right now is basically the company losing 20% of its revenues to China. So when you value the company based on that, if you value the company based on the 20% loss in terms of the Chinese revenue, the company's IV currently drops significantly and you'll see a lot of multiple compression as well. So I think at 18%, ASML, although it's a high quality business, is a company that has a lot of risk. And for me, I would tend more towards allocating my position and my sizing based on the downside risk of the company. And that's how I'm considering a company now, which is miles high, and trying to allocate a significant portion of my portfolio into that stock. Next one is Amazon. 10% seems about right. MSCI is fine. It is a quality business. Nvidia is fine as well, I would say. Equifax is a company that I'm interested in, but the business is a bit too complex. There's a lot of different factors that can affect the business, which is unknown to retail investors. Last one is Visa. I think Visa is the most predictable business of the entire list here. So I wouldn't have it at around 3%. In fact, I own around 3% of Visa currently, and I would like to increase my position in Visa. I view it as one of the highest quality businesses out there, so I would definitely try and increase my weightage in the company. And besides that, he also stated that I want to add S&P Global and also United Health. I'm not sure what to add first and how to go around getting them both in my portfolio. Also at current prices, what positions will you increase in my portfolio? So in this portfolio here, I think the company that looks the most undervalued is ASML, but you already have an 18% position in the company. So the next closest one would probably be MSCI or Visa. I think the other companies in the list here are already fully sized in terms of positioning, or they're already fairly priced. Next comment, it says, "What Singapore stocks do you like and thoughts on Salesforce?" So for my Singapore portfolio, I own mainly two different piles of stocks. I own REITs, your retail mall REITs as well as your office REITs, as well as SIA. So SIA just reported their earnings. The earnings weren't that great, but the company dropped by quite a fair bit because of the headline number, which is that the net income dropped by around 55%. But if you have to look into their income statement, the operating income actually dropped by around 13% only, and they're basically pulling back a lot of the growth that they had in Q1. Although the operating income dropping by around 13% would be a worrying one, I think the company is a predictable company that will give you around 10% returns every single year. And I'm comfortable holding on to the company, especially since my dividend yield is currently now at around 6%. As for REITs, they are undervalued because of your interest rates. And once your interest rates come down, that could be a tailwind for all your different REITs. Next one, Salesforce. So for Salesforce, it is a software company, but a few things to note for Salesforce. Number one, revenue growth has been slowing. The company has been decelerating in terms of growth. Number two, the CEO is doing a lot of different acquisitions. So if you have to look at the past acquisitions, like Slack, for example, Slack wasn't a company that was acquired at a very good price. So I believe they paid around 25 billion for the company, and it is still lagging behind Microsoft. So for Salesforce, I think it is a company that could be predictable, but two things to note: I don't like how the company is allocating capital, and I also don't like how the company is slowing in terms of the growth. I hope you guys have found this one useful and invest safe.